All right, well, good afternoon, everyone, and welcome to our market update and fourth quarter outlook webinar. As a very brief introduction, Manning & Napier is an investment manager headquartered in Rochester, New York, with a 50-year track record of delivering positive results for our investors. My name is Jake Symoniak, and I'm a senior global equity strategist here at Manning & Napier. Today, I'm joined once again by Brad Cronister, a senior analyst in our fixed income group, to talk about what we're seeing in the economy and then sort of get into the changes and maybe some of the divergences that we're seeing in financial markets today. I do want to highlight the resources tab where you can read and download more insights, including a copy of the slides, our latest notes from research publication, and a survey to share your feedback on today's event. If I can, before we get into things, I want to do what I've done before and sort of set the stage for where the conversation is going to go. First, we're going to take stock of where things stand from the perspective of the U.S. economy, inflation, and really just the broader market, across fixed income and equities as well. From there, I want to transition the conversation and really focus on some of the changes and the divergences that we're seeing in markets today, and potentially even a regime shift that we're seeing kind of in the broader financial assets as well. After that, we'll get into a couple other topics and hopefully have time left at the end for questions. So, Brad, from there, we've kind of started these conversations in the past, talking about the economy. And again, I think that's the right place to start, to really take stock of kind of where we're coming from, talk a bit about where we're going to go. And over the last several quarters, as the economy's evolved, I think resilience has really been the theme that we focused on. And I think it's where I want to start today. So if we can, let's talk a bit about the economy. Let's talk about some of the sources of strength and resilience. And let's maybe also talk about some of the pockets of weakness that we've seen as well.
Sure. Thanks, Jake. I think the story continues to be that economic activity, at least within the U.S., is underpinned by a pretty resilient consumer. There are a lot of valid concerns about the bifurcated nature of the consumer, but I think for the most part, that's kind of the steady state that we've been in for quite a while. What we're finding is that spending on services, which continues to make up a larger and larger part of the overall economic activity, is not as yield sensitive as we would have originally thought, and that it remains strong. Going back, we've had large upward revisions to both GDP and gross domestic income over the past year. So the economy remains in a pretty solid place. The one place we are seeing some pockets of weakness, I think demand for goods in general, things that are a little more yield sensitive, such as autos, those are still under pressure. We're not seeing an uptick in consumption there from the consumer. Investment continues to be subdued. One of the main things that we've been tracking is small business confidence, and the amount of uncertainty that you see within surveys like the NFIB are that uncertainty for small businesses is as high or higher than during 2020. So the election and what policy might look like going into 2025, along with just continued recession worries, is certainly putting a halt to investment by companies, but it's also slowing the pace of hiring. You're not seeing outright firings yet, but the pace of hiring has certainly slowed over the past 12 months. The way we think about it moving forward is the risks are now two-sided. I think there's a strong case to be made that we've been in the soft landing for the past 9 to 12 months. We've had disinflation for 18 to 24 months, and we've had modest weakness within labor markets for the past year. That, to me, is by definition a soft landing. And so now the economy is at a point where we're either going to see the legacy and long and variable lags of tight monetary policy bring that softness into weakness and outright contraction for the economy, or we could have a reduction in uncertainty, couple that with easier monetary policy, maybe some stimulus outside the U.S. You could actually get a push in goods spending higher, as well as investment improving going into 2025.
Great, I appreciate that. And you mentioned labor. I do want to move on to labor markets in a minute, but I do want to touch on a couple of things you said. I think it's right to point out, when we think about the consumer, just the incredibly strong fiscal stimulus that we had post-COVID, the direct-to-consumer fiscal stimulus that obviously boosted consumption kind of across all income cohorts. And I think that that's important to think about, because the other thing you mentioned is the bifurcated consumer. And there has been a lot of focus on weakness at the lower end. I think the thing that's important to think about is that at the end of the day, it's not a terribly fun thing to think about, but that the lower income cohorts in this country do tend to struggle. And when you think about the composition of economy, of consumption in the US economy, the lowest quintile of income accounts for, call it like 3 to 4% of income. If you combine that with the second lowest quintile, you get up to about 20%. But you go to the top and you think about the top two income quartiles in this country, and suddenly you're talking about 60% of consumption, right? And you think about a labor market that has remained fairly resilient. And then you think about household net worth, right? You think about what's happened with equities, with home prices, with being able to earn like a real yield on income for the first, or on low risk investments for the first time in a long time. And you start to put that stuff together, and suddenly it starts to make a bit more sense that consumption has held up the way it has. Now, we both mentioned labor, and I think that's something that we want to move on and talk about next. One of the areas that we have seen more mixed data has been the labor market for sure. So if we can, maybe you can dig a little bit into that and talk about some of the sources of weakness, but also some of the sources of resiliency that we've seen as well.
Sure. There's no question there's been softness in labor markets over the past 12 months. Unemployment has kind of marched higher until September's employment report. So unemployment moving higher, driven by some modest amounts of supply. I think when we talked back in July, Jake, there were three main things that we were looking at that were a little more forward leading indicators of labor. First being jobless claims, initial jobless claims. The second being the breadth of hiring. So how many industries are actually going out and hiring new workers. And the third being, what is temporary employment doing? I think on claims since July, they've been trending down, which is usually a good sign for labor markets. We got a new report this morning showing a significant uptick in initial jobless claims. I think that was a bit impacted by strikes at Boeing that started to occur in October. So I think for jobless claims in general since July have been improving. On the breadth of hiring, it had been weakening up until September's jobs report. September job report was kind of a blowout. You had 250,000 increase in non-farm payrolls, and the hiring was widespread. It wasn't just focused in healthcare and government, it was across the board hiring. So that is one data point that has improved a bit. But since July, I would call it mixed. And the one area of weakness that we continue to track is in temporary employment. You have not seen a pickup in hiring there. That continues to be weak overall. But Jake, I know you've done a lot of work on the increase in the unemployment rate. We've heard about the SOM rule for the past 6 to 9 months. Do you think it's a reliable signal? What are the conclusions that you've taken away from that?
Yeah, so I can weigh in on that real quick. I mean, just for those of you that are on, when we talk about the SOM rule, what we're looking at is the difference in the 3-month moving average of unemployment compared to kind of the 12-month trough in unemployment. And typically, when that hits 0.5 or higher, it has been a strong signal of a recession. So I guess to answer your question directly, historically, there's no question that it has been a strong signal. Now, I think the thing that's interesting is when you start to decompose the rise in unemployment during this cycle, right? And one of the things you mentioned just now is temporary workers. So you look at temporary contracts sort of rolling off and also temporary workers being laid off. That has certainly been a contributor to unemployment rising. What's interesting, though, is that the main driver this time around, really over the course of the last, call it 12 months or more, has been an increase in the labor supply, which when you think about it, is actually fairly healthy and certainly not tremendously nefarious at all. I think one of the things that's most interesting when you think about the SOM rule right now is that one of the most vocal critics of its ability to predict a recession in the current cycle is actually Claudia Sahm herself. So she's out there saying that it shouldn't be relied on as a signal the way it has in the past, exactly because of the dynamic that we just talked about with rising labor supply. I think the other thing that you probably take some solace in with that is that's certainly a source of downward wage pressure as well, with people coming back into the labor force, an increased supply, relatively resilient demand, all else equal, wages should fall. And I think that transitions well into talking about inflation, right? We got the inflation print today, but when we think broadly just about where we are, I think it'd be good to touch briefly on just how inflation has evolved, kind of what the drivers might have been, what they are now, and why we were in a position where the Fed felt comfortable to cut when they did.
Sure, yeah. So I think it's important context for inflation has been decelerating for the past almost 24 months. We hit a high with a 9 handle back in 2022, and this morning's report headline inflation is in the mid 2. So there's been pretty remarkable progress on the inflation front. Now, most of that improvement, if you will, on inflation is goods deflation. So weaker commodity prices over the past 18 months, a stronger dollar, and kind of a weaker external environment has led to prices for goods now beginning to actually decline on a year-over-year basis. Where we are seeing continued strength in prices is on the services side. So rent and housing costs continue to be high despite higher rates. But even outside of rent, services pricing is still too high, I think, for what the Fed is looking for. I think anyone who has renewed auto insurance over the past 6 to 9 months can attest that prices for services are not coming down, they're actually accelerating. So that's a bit of a worry to not see the services prices come down. On top of that, all the progress that we made for goods going back into deflation like we had, in the previous cycle, there's a worry here that, let's say global demand does improve and you get easier monetary policy, there's potential for prices of goods and commodities to actually find a bottom here. And in 6 to 12 months, we're no longer talking about disinflation and deflation within goods. We're actually talking about a reacceleration in inflation, just as the Fed kind of hangs their mission accomplished banner across for getting inflation back to their mandate. So I don't think the Fed or markets are really positioned for this increasing risk.
Yeah, I think you made a lot of good points there that, really is kind of the meat of the conversation that I want to get into, I guess, in the back half of this. But before we do that, I do kind of want to, I guess, just summarize the picture that we've painted, kind of the environment that we're in right now. We're coming out of a period where growth has remained incredibly resilient. We've seen risks skewed to the downside more than we do to the upside. We're in a position now where risks seem more or less, I guess, evenly balanced, or certainly more evenly balanced than they have been in the past. We're also in a position where we have come off of a pause and the Fed is cutting, but inflation remains, above trend for sure. Well, above the long-term average and certainly well above the Fed's 2% target. And I guess sitting against that backdrop, we're looking at an equity market that's trading, more than a standard deviation expensive against its long-term average. And when I think about what we've seen out of equity markets this year, there have been periods where performance sort of changed meaningfully, but more or less it's been more of the same, right? The Mag 7 continued to dominate performance. U.S. equities continue to climb at or near all-time highs. It's been the same factors that have been outperforming. It's been momentum, it's been cap, it's been growth. Now, we certainly had some periods during the year, right? I think about the CPI print that we got in July after a string of prints that had surprised to the upside. CPI came in, surprised to the downside. We started to price more aggressive rate cuts. And you did see a rotation under the surface in what was working, right? You saw small caps meaningfully outperform. At one point, you had close to a 20% divergence in performance between the Mag 7, which were falling, kind of led by semis, and the Russell 2000, which just continued to climb. You had a rotation into more kind of pro-cyclical sectors that had been left behind. We had periods where, I guess, post that, where economic growth became a concern, and defensives outperformed for a small period, very small period of time. But at the end of the day, I think the thing that stood out to me is more or less it was kind of a story of a continually rising market. And for the most part, even when you had sort of a rotation in what was working in the market, it was typically because you had sectors going up more than others. It wasn't like you had a massive spread and you had meaningful drawdowns kind of across sectors. So we find ourselves in a position now where risks are pretty evenly balanced, I'd say. And I guess the path forward from here, and we'll get to this in the latter half of this, is somewhat binary, right? You either get a recession or you don't. And against that backdrop, we're looking at a market that's incredibly richly valued, with certain sectors that continue to be fairly heavily owned and other sectors that could potentially benefit from some of the dynamics that we're seeing in the market that are under-owned. So I think it sets up for a potentially, I guess, interesting next 6 to 12 to 18 months, depending on kind of the path that we get forward from here. So with all of that said, I do want to get into the back half of the conversation, right? I want to start talking about some of the things that are changing under the surface in markets, some of the things that are much more obvious that are changing, and potentially some of the divergences that we're seeing between asset prices and different asset classes, because I think that that's a pretty interesting discussion and, something that we should really focus on from here. The most obvious thing that has changed, Brad, is that for the first time in a long time, and maybe you can talk a bit about that, we're now entering a cutting cycle as opposed to a hiking cycle, as opposed to a pause. So if you can, maybe you could just give some perspective just in terms of the duration of the pause and really talk about what went into the decision by the Fed to cut despite inflation running well above target here.
Sure. So from the time of the last hike back in 2023, early 2023, to the time of the first cut just 3 weeks ago, that's the longest time we've gone between the last hike and the first cut. And I think that's because the Fed has been solely focused on bringing inflation down. When you think of the Fed's dual mandate of inflation and employment, for the better part of 3 years, they've been solely focused on getting inflation back down to their target. And that long duration between hiking and cutting, they thought allowed them to cut by 50 basis points in September, a bit more than what most market participants were expecting. For them, this was a recalibration in rates. And if you listen to Jay Powell in August during the Jackson Hole Summit, he talked about no longer wanting to see any more softness or weakness in employment. And so to me, that shifts the focus now towards making sure that unemployment does not go up any more than the 4.3% rate that we saw recently. And if you were to talk with the Fed, they would tell you that a rate at 4.75% to 5% is still operating with tight monetary policy. So they still think that there are risks that unemployment can continue to march higher, and that they think that they've made a ton of progress on the inflation front, even though we're still not to their target. In terms of them operating with tight monetary policy, I think there's real debate over how valid that is. Financial conditions are extremely easy. Valuation across risk markets would say that you are not tight at all. And it's certainly not hard for companies to come access capital markets, whether it's debt financing, whether it's equity financing. It's more expensive financing than it was, say, 5 years ago. But pretty much any company across the rating spectrum can come to market and get debt financing or equity financing. And so to me, that says that financial conditions are much easier than they would otherwise tell you.
So on financial conditions and kind of what the market is pricing more broadly, I think this is one of the areas where some of the divergences that I've kind of talked about over the last little bit might start to come into play. Now, full disclosure, when we pulled this data about a week and a half ago, the implied Fed's fund rate was a bit different than it is now. But when you look at the magnitude of cuts that are currently being priced into the market or were being priced into the market, especially as rates were falling, can you talk a bit about whether or not you think that made sense, whether you think it makes sense now, and really kind of what kind of environment do you think that we would have to get to have gotten those types of rate cuts?
Yeah, so 2 weeks ago when we were pricing in Fed funds rate by the end of 2025 of sub 3%, to me that was signaling a relatively significant recession risk priced into rates markets. You weren't really seeing that pricing in other markets, certainly not in credit, certainly not in equities. But a Fed funds rate at 3 or below 3% would be about 225 basis points of cuts over an 18-month period. That's really only seen during a recession. So there was real recession risk being priced into the market right when the Fed was beginning cutting rates. To us, that seemed a bit aggressive. I'm not sure, 3.5% is completely out of line with a neutral rate or the rate that they ultimately could come down to. But that amount of cuts in that short amount of time felt like an overreaction. It's been interesting, the market reaction since the rate cut back in September. Yields across the curve are anywhere from 40 to 50 basis points higher. So that would actually tell you that nominal growth expectations for the US economy have increased. And certainly the jobs report from September has really priced out recession risk. And we're now pricing in a Fed funds rate of about 3.75%, maybe 3.5% by year end of 2025, which to me seems a bit more reasonable than where we were just 2 or 3 weeks ago.
Yeah, no question. I think that divergence that did exist a few weeks ago was certainly a topic that we were talking about a lot here. Basically, you think back to the chart that we put up of the equity market trading as expensive as, I guess, ex-COVID, as expensive as it's traded in decades. And you think about the type of earnings growth you would have to see to support a multiple like that. And then you start to look at fixed income markets, pricing in cuts like that. And it seemed pretty clear that something had to change. Now, I think you mentioned rates rising post-cut. One of the things that's interesting too is to think about historically kind of what equities have done in a, I guess, post-first cut world, right? And you look at this chart, and I mentioned earlier that we were in something of a binary situation, right? When you think about equities, and I think this chart shows that pretty well. We're now, I guess, getting closer to that 30-day mark just right of the vertical axis on this chart. But it's pretty clear that you get two dramatically different outcomes after the first Fed cut, kind of depending on the economic backdrop. And you think about it, it makes sense, right? Recessionary environment, I think there's two fairly direct channels that impact the equity market. The first is just going to be, call it multiples, call it confidence, call it animal spirits, but people get scared, they sell equities, the market derates. The other side of that is in a period of economic weakness, that has very real effects on corporate fundamentals, right? You have slowing growth, which flows directly to the top and bottom line of these companies, potentially squeezes on margins, depending on the operating leverage. You're just in an environment where it logically follows that equities would fall. Now, they'll probably make a bottom before the recession is officially over because markets are forward looking. But in an environment where you do get a recession, equities tend to fall following the first cut. The flip side of that is the opposite, right? You find yourself in an environment where financial conditions have been tight, either real or perceived, to the point you made earlier, because I tend to agree with you. There's not a lot you can look at that would tell you that outside of maybe small businesses having to pay elevated rates, not a ton looks particularly tight. but you end up in a situation where people go from being worried about tighter credit conditions to potentially easier lending. Maybe you get multiple expansion. Cutting rates should theoretically help growth. And again, that flows straight to the bottom line of companies. You're in an environment where equities can just continue to melt higher. Now, post-cut, you tend to get equities melting higher for a month or two in both scenario, and then it breaks one way or the other. And we're again getting to that point where, the market's gonna, I guess the economic outcome is going to be what it's going to be, and the market's going to react accordingly. So moving on from equities, I do want to spend a bit more time, Brad, talking about fixed income and really kind of what we've seen from fixed income markets and what you expect maybe going forward, how we're positioned, because we do have you on here, and I think it'd be a great thing for you to be talking about.
Sure. Maybe I'll just start with how we position duration coming into the year and kind of how it's evolved within the portfolios through the first 10 months now. We came into the year slightly long duration across our fixed income objectives. As rates sold off and we got above 4.5% during the first quarter in February and March, we felt that there were multiple ways for duration to be positive for client portfolios. So we started adding duration as the 10-year got above 4.5%. With the thinking being that in a soft landing, rates were likely to come down. In a recession, rates were likely to come down. So there were multiple avenues for duration to do well. And that started playing out really in the beginning of the third quarter, in July and August after the CPI report you referenced. And then it really started to play out as we got some softer non-farm payrolls for the July and August reports. As the market started to price in 200, 250 basis points of cuts, inflation expectations started to come down below 2%. We thought it was prudent to begin to reduce duration. So where the portfolios sit right now, we actually have reduced duration back to kind of what we would consider a more neutral stance. And we did that back in August and September. It's not that we don't think that 4% rates on a risk-free asset across the curve is unattractive. It actually, compared to the first 10 years of my career where rates were negative in Europe and Japan and basically zero here in the US, 4% rate, 2% real rate is relatively attractive, but we do think that there are upside risks potentially. So a neutral duration makes sense here. I think where we are positioned is most of our duration is within the belly of the curve. So think your 5-year, 7-year bucket, as we think there are multiple ways for the yield curve to steepen, whether it's through your traditional bull steepening, so yields coming down, but yields coming down more aggressively in the belly of the curve, should we get a recession, or a bear steepening if you get reflation risk starting to reemerge, in which case being underweight the long end will do well. So that's kind of how we're positioned on the rate side within client portfolios. I talked about recession risks, at least 2 or 3 weeks ago, being pretty well priced in rates market. I mean, within credit markets, you're not pricing in any recession risk. We've now reached basically cycle lows in investment grade and in high yield credit. And back in July, a main topic of conversation that we talked about was the bifurcated nature of credit markets. So investors wanted to be in corporate credit, but they wanted high quality. So you looked at the spread between BB and CCC high yield bonds, and that was actually pretty wide. People wanted to own BB, but kind of shunned the CCC side of the market. That spread has basically converged, and now all rating spectrums, whether it's CCC, single B, BB, and investment grade single A, BBB, all of credit is at multi-year cycle tights. So it's tough to see any worries within credit markets right now. We continue to find some selective opportunities. We really like front end securitized. Those are high quality assets, typically double A, single A asset backed securities. We have a base rate of about 4.25, 100 basis points, 125 basis points of spread. So you're kind of earning a decent yield at 5.25, 5.5% on really high quality assets, and kind of within our credit bucket where our credit risk is, that's where we're putting a majority of that weighting in. I would say right now, it's really about maximizing alpha over beta. So portfolios in general are maximizing idiosyncratic risks, not taking a lot of market risk. But we feel like we're in a position where we can really capitalize on market dislocations should volatility return to the market.
I do think that point you make about volatility too is probably something worth thinking about, or at least mentioning here. Really, when you think about how markets have transpired over the course of the last year plus, kind of post the stress we saw in the banking sector in the US in early 2023, especially in equities, volatility has been fairly subdued, right? That's kind of been a characteristic of markets. But I think one of the things that I tend to think about is that, I don't know, suppressed volatility, low volatility, whatever you want to call it, tends to breed higher volatility in the future, right? You end up very complacent. And as things start to change, you can get more violent movements in markets. Now, I don't know about the extent to which you've seen that in credit markets, in sovereign markets. But when I think about equities from here, I think it's fairly difficult to find what I would consider really fat pitches or really obvious investment ideas that you want to be pursuing. What does seem clear to me is that one of the things that we should expect is for volatility to pick up, right? Whether it's geopolitics, whether it's the election, whether it's a shifting, I don't know, inflationary backdrop, shifting, I guess, an economy that can go two different ways from here. I think one of the higher conviction views that I do have from here is that we should expect volatility to pick up.
Yeah, and I think to your point too, we've talked about divergence of rate market recession pricing and equity or credit, recession risk pricing being extremely low. You see that in volatility too. The MOVE index, which is think VIX for treasuries, is still relatively high. You're pricing in a distribution of about 100 basis points of movement for the 10-year, which over the last 10 or 15 years is on the high end of volatility for rates. I mean, you can speak to the VIX or general volatility pricing within equities, but that seems to be still relatively low. So you are pricing in some expected volatility within rates pricing, but not really pricing in the expected volatility within risk or equity pricing. And at some point, I would think those two converge, and whether that's rates just find kind of a steady state in the 4.25 range and interest rate volatility has to come down. Or, I mean, typically we see VIX pricing and options pricing for credit start to be bid. So I think that convergence probably plays out over the next 6 months or so.
Yeah, I like that point too. And I think it gets to, one of the next things that we wanted to talk about. And that's really, you don't see, you still just don't see that volatility. You don't see that risk priced into equities, especially in the US, right? You continue to make all-time highs. And again, it's for the first time in a while, things seem very, very binary from here. They have to break sort of like neutral to higher and reaccelerate, or they have to break lower. And to me, it's a bit more difficult to just see things sort of plodding along from where we are. And I think what's really interesting to think about in that environment is, okay, for a while now, the same things have been working. And it's the conversation that we had a few minutes ago when we were talking about kind of what we've seen in equity market year to date and even before that. But if the environment is truly changing, you would expect that at some point, maybe you get that rotation internally. I think the question is, is it people moving from, bonds into what has been working and that continues to be the case? Is it people moving from what has been working to parts of the market that weren't working and you kind of work sideways to higher that way? It seems like with things changing the way that they are, with some of the divergences that we're seeing in markets, it makes sense to wonder if things can persist the way that they have. And I think maybe one of the better examples globally of how things are changing a bit is really kind of what we saw in the Chinese market at the end of September. Now, I can get into that, Brad. I don't know if you want to weigh in and talk about some of the stimulus measures, or you just want me to kind of get right into it. What do you think?
Yeah, no, I was actually going to ask you. I mean, we've had monetary stimulus announcements. We're kind of waiting to hear about the details for the potential of fiscal stimulus out of China. I mean, what problems do they have? What are they trying to solve? How
Yeah,
do you play China from here?
yeah, absolutely. I mean, I think it's worth talking about for a couple of reasons. The first is, from an equity market standpoint, anybody invested internationally, anybody who can invest in emerging markets, it's impossible not to take note of the move that we've seen in Chinese equities, I guess for two reasons. One is just the violence with which the equity market has moved higher. The second is really kind of the base off of which you're coming. And maybe that's a better place to start. When you looked at absolute valuations, relative valuations, you look at actual ownership of and allocation to the market. Again, on an absolute sense, looking at equity flows, kind of rolling equity flows out of the country, and just even relative ownership of markets like India compared to China, everything looked extreme, right? And that type of setup is really just a tinderbox where if anything changes, you can get violent moves the other way. And there's no question that that's what we saw, right? So I think in talking about what we've seen in China so far, it's important to break it into two buckets, right? You've got the equity market and you've got the real economy. So speaking directly to the equity market, the conditions I talked about are what was present. We saw a change, we saw stimulus. Part of the stimulus that we saw was targeted directly at the equity market. And it's not a surprise, kind of given those dynamics, that it rallied the way that it did. The real question you have now, I guess, is twofold. A, can it be durable and have an economic impact in China? And B, is it strong enough that you start to see a durable impact out of China? And I think that second question really gets to kind of the last part of the conversation that I want to have. So I'll get there in a minute. The first one, though, you think about the problems that they have in China, right? You think about the way that they reacted to COVID. And when you think about China, you think about the structural problems. You hear debt, you hear demographics, you hear property bubble. And it's clear that over the last several years, Xi and the CCP have prioritized kind of at various periods addressing those issues in different ways. So post-COVID, because of the strength of the export machine that they have in China, they decided that instead of stimulating, they were actually going to go the opposite way and start to try and unwind the property bubble. And I think the thing that's interesting, and maybe the thing that they underestimated, was the extent to which cutting off the supply of credit to the Chinese property developers and just the market in general really turned from a supply side issue in which people couldn't get access to the credit they needed to complete projects, inventory started to rise, property prices started to fall. The problem is in a country where 60 to 70% of financial assets are in property and prices start to fall, you kind of cross the Rubicon, right? And it went from a supply side issue to a demand side issue. And think about a country like Japan in the early 90s, where you had a property bubble bust. What you really need at that point is really, really strong fiscal to come in, support demand, put a floor under property prices in China, and give consumers the confidence to stop saving money and start spending money again. And that's the only real way that you kind of achieve the transition in their economy that policymakers have talked about for a long time. Now, I look at the measures that they announced a couple of weeks ago. I look at something like, increasing financing to developers, probably a positive on net. I think maybe the real thing that policymakers are hanging their hat on is a policy like bringing down mortgage rates for existing mortgage holders. I think the problem, and maybe the question I have, is do you think that they're going to take those savings and go out and spend, or are you going to see more of what you've seen, where they save the money and they start to pay down mortgages? So it stands out to me that a couple days ago, you had the National Development and Reform Council come out. There were expectations for this announcement of massive fiscal stimulus in China, and they disappointed, right? They disappointed severely. And you had the Hang Seng down, what, 10% that day? Now, the A-share market was up about the same, but there's interesting dynamics there where that market had been closed for several days. You had people coming in and kind of chasing the rally because they hadn't been able to access it and open accounts and put money in. I think it just goes to show that just the expectations and kind of what you need in a market like that to move forward. I'm not entirely, well, I'm entirely convinced right now that what we have seen can make a difference in the equity market short term. I don't expect it to have a long-term significant impact on the economy. Now, I guess the question I would put to you, Brad, is do you think policymakers are in a position where they will ultimately follow through and announce that kind of stimulus? Because that directly affects the second question I asked, what could the potential impacts be more broadly, kind of in a global sense?
Yeah, I thought it was interesting that the policy that has been implemented in a country like China was directly related to stimulating or getting equities higher, as opposed to having concrete announcements about fiscal stimulus and supporting a consumer where youth unemployment is upwards of 20 or 25%. We're not sure of the exact numbers because they stopped publishing them. But so to me, I think that there's real chance that China is going to stimulate specifically on the consumer side. And the way that plays out globally will be interesting because that could really start to see a leg up in commodity prices, see a leg up in demand for goods. I know there's risk that Chinese consumers end up just pocketing that stimulus and paying down debt. But if it looks anything like what the US saw in 2020 or 2021, I think there's real risk that we see a stimulative policy that could actually put upward prices on globally after China has basically been exporting deflation for the last 2 or 3 years.
Yeah, so I tend to think that's right. I tend to think in a communist country, once you commit to changing policy the way you have, and people don't have the ability to go to the voting booth, voice their displeasure, it would seem that you're probably pot committed to stimulating more aggressively. Now, I don't know that things don't have to get worse before you get to that point. But ultimately, I do think you probably end up in an environment where you do get that more aggressive stimulus. And I think that maybe gets to the most interesting topic to me here that I kind of want to finish with before we get to Q&A. I think broadly about a lot of the topics that have come up on this conversation. We've talked about downward wage pressure in the US. We've talked about inflation moving lower. We've talked about central banks fighting inflation. We've talked about weakness in commodity prices. What's interesting to me now is I think about the things that we're seeing in the world. And again, some of the topics that we touched on here. And I guess to bucket things broadly, we've been in a fairly disinflationary environment for the last year plus. If we are now in an environment where, the Fed is cutting with inflation still well above target, we think there's potential upside risks there. If we're talking about a world where geopolitics have the potential to meaningfully disrupt oil supply in the Middle East, and I'm not saying they do, I'm saying they could. If we're talking about a world where commodity prices were already starting to turn a bit higher before Chinese policymakers really seemed to turn things around and stimulate more aggressively, are we suddenly talking about a more reflationary environment? I guess maybe I would just turn it over to you and say, A, can I get your thoughts on that? And B, kind of what do you think the investment implications of a world like that could be?
Yeah, I think it's important to contextualize it. So I'm not sure that that's reflation, higher nominal growth would be my most likely or modal outcome. But when you look at what is being priced across asset markets globally, whether it's equities, whether it's credit, whether it's yields, I think that's probably the scenario that is most disconnected from current pricing. And so the magnitude of a move, should we go down that path of reinflation, higher nominal growth, could have pretty big disruptions across the board. I think within the market that I look at in terms of fixed income, what's really underpricing that type of scenario, it would be tips. So inflation protection is still relatively cheap in a world where we might be getting some reinflation. I think the yield curve could bear steepen, meaning that the long end of the curve could really underperform kind of the belly and front end, as that inflation premium, that term premium has to be repriced within markets. And you probably want to start looking at, how do I increase my reinvestment rate risk? Looking for income producing assets on the front end of the curve that, can give you 5.5% yield without much down in quality or taking on a ton of duration risk. So I think kind of, barbelling your portfolio to an extent using that makes a lot of sense here, given the uncertainty and given the upside risks and downside risks.
And I am going to flip it right back at you because I tend to agree with what you said about the modal outcome, right? We just spent a couple minutes focusing on the potential for a reflationary outcome. But again, as we've mentioned a couple times throughout the course of this discussion, there is the potential for things to move lower and things to get worse. What is, maybe in 30 seconds, kind of what is the path towards that type of world? What does that look like?
Yeah, I think it's all about labor markets. If unemployment is not capped here at 4.5%, if that continues to creep higher, and it's not just supply, it's actual layoffs, it's firings, it's broad. I think that's the main thing that we need to keep an eye on, and I think that's where it'll shift, because at that point, the consumption story that we led the webinar off with, that kind of breaks down, and all of a sudden that negative feedback loop works out in the wrong direction. So I think that's the main thing that we're monitoring in terms of downside risks.
Great. Well, listen, I appreciate the conversation. I think that's an interesting way to kind of leave off the prepared remarks. We do have a couple questions that I want to make sure we get to. I guess, unsurprisingly, the first one is about the election. I guess maybe just broadly, Brad, do you have any kind of overarching thoughts on the election, or maybe a better way to ask, how are you thinking about it right now?
Yeah, so we don't position portfolios for any specific election outcome. That's, not what we do. What we do is put portfolios in a position to actively move chips around should you get some market dislocations. I think, should either party sweep the election, there should be higher term premiums within rates markets. There should likely be higher inflation risks, as you're likely to get more fiscal stimulus, whether it's tax cuts on the Republican side or spending on the Democratic side. So be probably looking for higher yields, steeper curves, should either party sweep the election.
Yeah, and I think for me, you said that well. We're not in the business of trying to necessarily guess who is going to win and what that might mean for markets. I think the important thing to do is kind of look at what the potential election outcomes are, which of those scenarios is maybe more high impact. And I think you highlighted those well. And then kind of look at your portfolio and just ask yourself, listen, if we do find ourselves in a position where we get one of those higher impact outcomes, am I positioned in such a way, maybe purposefully or inadvertently, where I am susceptible to a significant move in the portfolio on one of those high impact outcomes? But past that, I think trying to guess what's going to happen is just not, it's too close. It can go too many different ways. And even if you guess right, things can not work out the way you might have thought. So, the last question we have here is we have a question about investing specifically in China, Argentina, and Mexico. I feel like we addressed the China question, fairly thoroughly. I know that you do look at global fixed income as well. So I don't know if you have any particular views on Argentina or Mexico. We can kind of go back and forth on that for a minute.
Yeah, no real specific views. I think just from a high level, it seems both countries are going opposite directions in terms of policy. Kind of have structural tailwinds in Argentina with Milei. And then within Mexico, kind of what will likely be a second, continuing of AMLO's policies is probably a net negative, though you do have structural tailwinds in Mexico with friendshoring and moving supply chains closer to the US. So I think it's kind of a mixed bag in Mexico, at least from like a sovereign credit standpoint.
Yeah, I tend to think that's more or less right. I think it's important. I don't know. I think context matters, right? And Argentina is one of these countries that kind of bounces back and forth historically between crisis and moving to fix things. It shouldn't be lost on anybody that Macri won an election several years ago, started undertaking pretty significant structural reform, basically faced enormous backlash, lost an election, and immediately backtracked, got back to a point where, the currency was in free fall and these equity investments that looked great were suddenly not so great. Now, I think there are meaningful differences between that time period and now, but Argentina to me still feels like one of those markets that you buy with the intention to sell. Mexico may be a bit different in that I tend to agree that Scheinbaum's likely to continue a lot of the policies that you've seen under AMLO. I think the judicial reform that we saw a couple weeks ago, clearly a net negative. But at the end of the day, it's still a country that's seeing dramatic investment inflows, not only from the US, but even from China, right? Like if the US is not going to be importing directly from China, you're seeing Chinese factories start to spring up in Mexico because we'll import from there. So you do have some structural tailwinds. And, from an equity standpoint, valuations are incredibly compelling right now. So I think that's probably something to keep in mind as well. I don't know. With that, I think we've come to the end of the time that we have for today. I want to thank everybody for taking the time out of their day to be here with us. If we didn't get to your question, and there's a couple we didn't, we'll be sure to follow up with you after the presentation. Please continue to reach out with any questions or follow-up that you might have. As a reminder, for your convenience, a recording of the webinar will be emailed to you. And again, please feel free to explore that resources tab for additional insights. Brad, thanks for being here. And everybody who hopped on, thanks for taking the time to be with us today.
Thank you.